active management in emerging markets is critical. If you had invested in the index over the last 5 years, you would have been at the third quartile. So there's a huge opportunity for active management in emerging markets.
Hi, good morning, everyone, and welcome to episode 7 of Unscripted in Conversation with eSpring. As you can see in the background, we've got SG60 celebrations underway. We're very proud of our heritage as a Singapore-headquartered asset management firm. This, interestingly, is the last episode in this series one, and we're going to see you back here in September. And what a way to kick off this episode than having our senior PM and a wonderful colleague of mine, Navin Hingorani, with us. Navin, great to have you with us on the show.
Yes, Salman. Thank you.
Great to see you. All right, let's walk and talk. So Navin, today it's all about emerging markets, and you and the team have tremendous insight into EM equities. I've spoken to a lot of your colleagues about the same theme amidst weakening US dollar, the tariff situation, which seems to be settling a little bit. What's the investment thesis and what's the opportunity set in emerging markets that investors aren't seeing yet and you guys are on the ground?
Yeah. It's a great question, Salman, and it's a really interesting time to be talking about emerging markets because, the starting point today is that you're coming off 15 years of almost continual outperformance for developed markets, and in particular the US.
Yeah.
And so the starting point for emerging markets in terms of valuations and in terms of positioning is really compelling. Yeah. So the first point is emerging markets are cheap. Mm-hmm. They're trading at a 65% discount to the US. And beyond that, investor positioning is almost at trough. So as an investor, what I like to think about is when are you going to make outsized returns? And the two criteria that you need, cheap valuations and something being unloved. Yeah. So our starting point for EM is strong in that sense, and it gives a great entry point. But then you need some kind of tailwinds behind it. And now we're seeing some tailwinds coming through that will be positive for EM performance going forward. So first and foremost, when you look at when EM outperforms DM, it tends to happen in an environment where the growth differential between emerging markets and developed markets is expanding. And that's the environment we're in right now. You're seeing stable to increasing growth in emerging markets versus declining real GDP growth in developed markets.
Yes.
So that's tailwind number one. Mm-hmm. Number two is the falling US dollar, which you mentioned. So what you've seen since 2000, 10 of the largest rallies in emerging market stocks out of 11 have happened in environments with a falling US dollar. Another third point is emerging markets are manufacturers, they're suppliers to the rest of the world. So they tend to perform very strongly when CapEx is increasing. Mm-hmm. Now, since the financial crisis, it's been an environment where CapEx has been declining. There hasn't really been any investment, whether it's at a macro or a micro level. Mm-hmm. But that's picking up. And one of the strongest relationships that you see for emerging markets is when CapEx increases.
Right.
So when you take those three factors, it all leads through to an environment now where you have faster EPS growth in emerging markets. You mentioned tariffs, and I think, it's important to talk about them because
sure.
it's topical and it seems to be in the news every day. So the key thing is tariffs introduce uncertainty, and markets generally don't like uncertainty. But for us, as value investors, looking at things from a bottom-up perspective, uncertainty creates opportunity.
Yeah.
And that opportunity comes about because in times of uncertainty, the market pays a high price for perceived safety, but it also tends to overcompensate on the downside by penalizing companies where there's a degree of fear.
Yeah.
So we have a great opportunity to be able to identify stocks that have been mispriced because of the fear that's created because of the volatility around tariffs.
Right.
And you asked, what are we seeing on the ground? Well, what we're seeing again from a micro and a macro perspective is very positive. At a micro level, what's very encouraging is that there's a huge focus on improving corporate governance across emerging markets. So you're seeing increased ability and desire for firms to pay out more capital, to be more prudent about their capital allocation. So looking at self-help measures to be able to improve their own returns. And then at the macro level, actually, the health of emerging markets is quite strong. A lot of the talk about the US now is about the fiscal deficit and about the spending there. Within emerging markets, actually, from a macro perspective, they look quite healthy in terms of their balance sheets.
Look, it's a very, very compelling case. Great points you've covered off, Navin. When we talk about emerging markets, you talk about a very diverse set of economies, diverse policies, et cetera, et cetera. how do you, from an active management perspective, manage that diversity of across 20, 25 economies, and how do you look at that? Because I think active management, we believe, plays an important role in terms of bringing the essential thesis into specific economies.
Yeah, no, most definitely. And look, emerging markets, you're right. It's 24 different countries. You're ranging across Latin America, Middle East, Europe, emerging Europe, and then Asia. So it's a universe of more than 3,000 investable stocks. So it's a huge universe. And emerging markets represents 80% of the world's population. So, you know, it's a big area. Active management in emerging markets is critical. If you had invested in the index over the last 5 years, you'd have been at the third quartile. So there's a huge opportunity for active management in emerging markets. But when you're looking at a universe of 3,000 stocks, it's really important to be able to identify what you want to look at. Because you've got, you know, limited resources and you need to be able to pick the right stock. So one of the first lessons I learned when I started in this industry was the first time you look at a stock is the only time you're going to be unbiased. Because invariably when you've looked at something in the past, it introduces some degree of bias. So we need to have a funnel, a filter, to ensure that when we are looking to exploit behavioral biases, we don't display those same biases. So the first method we will use to implement that is by looking at stocks that are cheap. On a relative or an absolute basis. And that gives us the opportunity to ensure that we're not being biased towards looking at popular stocks that are the ones that are most loved by the market.
Right.
So we'll take that, and you know, when we're looking at a stock that's cheap, we want to answer 3 questions. Why is it cheap? What does the current share price tell us about future expectations? And then third question, what do we think it's worth at a normalized level of return? And through that, we're looking to build into a structure that enables us to build that portfolio from a bottom-up perspective to identify high conviction stocks that are trading at cheap valuations, because for us, value investing works in EM. It's outperformed over the last 20 years. It's been one of the best performing factors.
Well, thank you for bringing it to life, Navin. 2 quick ones. Number one, you're running a strategy that we're seeing strong institutional interest in, which is GEMX China. Now, there is demand moving in for China, investor appetite for China. How do you look at GEMX China as a strategy, and how should investors be thinking about it?
So we started thinking about this, it was 5 years ago, actually, and we launched 4 years ago. So what was the thesis? The thesis back then was China had grown to be more than 40% of the index. And what you see when any country becomes so dominant in an index, it tends to, you know, overshadow the returns of that index as well as crowd out other opportunities.
Correct.
And to give you an example, so everyone knows DM has outperformed EM. Over the last 5 years, MSCI World has outperformed EM by 60%. If you take the US out of World and you take China out of EM, the returns have been the same.
That's amazing.
So it just shows you, you know, when the US dominates the world, EM dominates, China dominates EM. So let's think about it a little bit differently. If you go back probably to the 70s, that's when the US dominated MSCI World. Investors made a discrete allocation to the US. So we think China is in a similar place because it's very dominant, and that dominant effect crowds out other opportunities. And just to give you an indication, China is roughly 18% of global GDP, 3% of MSCI market cap. The US is around 27% of global GDP. 65% of MSCI market cap. So, you know, we think there are reasons that China warrants a discrete allocation from investors, and that allows you to then pay more attention to EMX China. Now, EMX China is itself a huge universe. 1,400 stocks. With a market cap of more than $2 billion. That's the same as you have in the US. You know, so within an EM universe, you really forget about a lot of those opportunities because they're insignificant, they're smaller. In an EMX China universe, they become a lot more meaningful because you're no longer having to put so much of your risk budget to work in managing a portfolio just looking at China. You can look at everything else as well.
Absolutely, Navin. And again, compelling statistics, which kind of, I think, important for all of our clients and investors to think about. So we usually close this with a punchline, and the punchline is, why should investors be thinking about, or clients be thinking about investing with you and your team? Give us the punchline.
So thank you for the opportunity. And I think, you know, one thing I'd say is, for me as an investor, when I think about when you're going in, probably the biggest determinant of your future return is the price that you pay when you go in. And that's why EM at the moment is really compelling.
Sure.
Because it's trading cheap, the upside outweighs the uncertainty, and the future is on sale.
Right.
So the opportunity that you have with the tailwinds that we've spoken about for EM are strong. And why are we in that position? We've been managing EM the same way for the past 15 years.
Amazing.
With a disciplined value approach, which has outperformed over the long term, and which gives investors a very unique portfolio within EM,
Sure.
focusing on the value space, which is looking at unloved opportunities which have a huge potential to outperform.
Love the punchline. Navin, great to have you on the show. What a way to close Series 1 as well. Very, very compelling. And thanks for being here.
My pleasure. Thank you.
Cheers, Navin. Have a good one.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。